Alright y'all, today is a follow-up video from the video that I posted yesterday. If you don't normally watch my Mr. Money Mustache videos that I put out on Mondays, make sure to go back and watch that one from yesterday, because this is an article by J.L. Collins that is discussing the blog post by Mr. Money Mustache that I read yesterday. The blog post was about dividend investing, and apparently that post sparked a little bit of controversy in the comment section of Mr. Money Mustache's website. So for this blog post, I will link to it in the description box below. This is from J.L. Collins. It'll be from his blog that he has. He is the author of The Simple Path to Wealth, which highly promotes index investing or ETF investing as an investing strategy over dividend investing. So we'll jump into this one. One of the new blogs I've been enjoying of late has been the site of a lively debate on investing for dividends. Dividend Mantra presents a guest post there on his dividend growth investing approach. Blog reader Dan, in turn, makes some very astute observations. I, of course, joined in. Dividend Mantra Dan, thanks for the lively debate. For those readers with some basic knowledge, it has been fun to sift through the conversation. However, for those who are new to this whole investing thing, they are likely more confused than ever with the conflicting claims. At the risk of stirring up the dust again, I believe it's important that beginning investors be very clear on what is accurate information here. Basically, Dan makes three key points. Number one, with vanishingly rare exception, index investing bests all other methods. Number two, receiving dividends in a taxable account is a taxable event. Number three, the payment of dividends represents a reduction in the company's value that precisely matches the amount paid. In each of these, he is absolutely correct. And then he goes into further detail with each one. Number one, with vanishingly rare exception, index investing bests all other methods. Far and away, this is the most important point. You can't consistently pick winning stocks. I can't either. The vast majority of pros can't. Warren Buffett has, but suggesting that his act is easy or even possible to follow is simply wrong and dangerous. Here's my take on why. And then he has a blog post linked of his, why I can't pick winning stocks and you can't either. Here's my take on what works. Another hyperlink there, what we own and why we own it. Again, I'm linking to this blog post in the description box below. If y'all want to click on it, you can see these other blog posts he's written as well. Dan said, quote, I strongly believe the research of the last 40 years has shown that any benefit achieved through active stock research and picking is due to sheer luck, not due to any true ability on the part of the stock picker, end quote. This is not just what you believe, Dan, it is absolute fact. The research is stunningly clear and precise on this. Number two, receiving dividends in a taxable account is a taxable event. Every penny of dividends you receive in a taxable account is subject to tax in the year you receive them. If you believe this not to be true, simply don't report them on your 1040 this year. You will shortly receive a private invitation from the IRS to explain your error in detail. The good news is, for those in the 15% or lower tax brackets, qualified dividends are taxed at 0%. But for those in the 25% and higher brackets, money will be owed. You may not share Dan's concern with paying these taxes or be interested in the ideas he offers to gain more control over how and when you pay taxes on your investment gains. Indeed, it is my opinion that taxes are not necessarily the first consideration in investment strategy. But if you hold in taxable accounts investments in companies that pay dividends, you will give up a portion of those to your Uncle Sam. This is an absolute fact. Number three, the payment of dividends represents a reduction in the company's value that precisely matches the amount paid. This too is an absolute fact, and I think Dan did a sound job of explaining it. Indeed, I have been puzzling over why people seem to be stubbing their toe on it. Perhaps it is simply a bit counterintuitive. Let me take a stab at clarifying it a bit. Maybe Newton's law of gravity can help. As we all know, Newton was the first to describe, not discover, it was always there, gravity and its principles. In short, any object with mass exerts an attractive force on other objects of mass. The strength of that force is directly proportional to the mass of the object. In the classic story, an apple falling to the earth illustrates gravity in obvious action. What might be less obvious is that the apple exerts gravitational force as well on the earth. just on a far smaller scale due to its far smaller mass. So if, as Newton's law claims, apples have gravity, why aren't two apples sitting on a flat table drawn together? Two reasons. One, gravity is a very weak force. Two, there are other stronger forces at work on the apples. The friction of the table surface, the resistance of the air between the apples, the much larger Earth's gravity trying to pull them down through the table. With that in mind, let's take a look at Coca-Cola and the example of its dividend, letting KO represent the Earth and its dividend the apple. Like the Earth, Coke is huge. 159 billion market cap, 171 billion in enterprise value, 46 billion in annual sales. Like the apple, Coke's dividend is relatively small. At 47 cents per share, paid to 2.27 billion shareholders, it is just over $1 billion. That is real money leaving the company, and that lost value is precisely the same as the dividend itself. However, just like the gravity of an apple is hard to perceive in the shadow of the Earth, so too it can be easy to miss the lost value to Coke of the paid dividend against the scale of the company itself. But the loss is no less real for it. This is why traders pay close attention to the ex-dividend date. This is the date that determines who gets the dividend if the stock is being sold. Before it, the dividend goes to the buyer, after to the seller. By the way, this is not the day the dividend is paid. The value of the stock will be affected by precisely the amount of the dividend paid. From Jordan in the comments below, an ex-dividend date illustration. Example, ex-dividend date is January 10th. Buyer buys before January 10th and the buyer will receive the dividend. Buyer buys on or after January 10th and they will not receive a dividend because the rights to it already went to the seller as the owner of record. The ex-dividend date is the first date that the security trades without the rights to the declared dividend. But wait, if this is true, how come sometimes the stock price will rise on the ex-dividend date or maybe fall even further than the dividend would call for? For the same reason two apples on a table aren't drawn together. It's not that Newton was wrong, it's that other stronger forces are at work. In the case of stocks, those forces are largely traders working with many variables, only one of which is the dividend payout. Like everything else in life, there is no free lunch when it comes to dividends. When Coke pays out that $1 billion in dividends, that is $1 billion that's gone forever. Is it $1 billion they could have used otherwise? Could they have wasted it? Of course. Or they might have deployed it to great advantage, creating more value per share than the 47 cents they paid out. Basically, there are four things that companies can do with their profits. They can pay them out as dividends, they can use them to build the company, they can buy back their own shares, they can buy other companies, they can sit on them waiting for opportunities. See, I came up with a fifth. Which is best? Depends on the management, on the company, on the industry, on the economy, to name a few, but none are magic. Those are the facts. So what about Dividend Mantra's dividend growth investing approach? I think he hits the value it offers best when he says, I live in a different world, the real world, where stock prices move up and down, are at times overvalued and undervalued, sometimes react stronger to dividend payouts, and sometimes completely ignore dividend payouts. This is a world where a company can grow earnings by 100% and see the stock price stay flat, where the stock price can go up and down by 10% or more for no apparent reasons. It's because of these drastic up and down gyrations in my world that I invest in dividend growth stocks. The extreme gyrations do not affect my steadily rising dividend checks. It will, however, affect the people who sell shares for income. They'll have to sell more or less shares to net a desired dollar amount depending on the day, and they are completely subject to the crazy market that operates in my world. In other words, it provides a smoother ride. As far as it goes, this is true. Companies that pay dividends tend to be larger, more stable operations. Management is loath to declare dividends and then have to pull them back. Although, make no mistake, this can and does happen, and the crash of 2008 was filled with companies forced to cut or eliminate their dividends. The price you pay is lower potential growth. Some observations. Number one, these same large, stable companies tend to grow at a slower pace. Number two, you will pay taxes on the dividends. Number three, if you implement this approach with individual stocks, you take on all the problems of point number one above. And focusing on dividends is trading growth for income. As I mentioned elsewhere in this blog, while I'm a firm believer in indexing, I haven't entirely given up on trying to outperform with a few individual stocks. As I've said, I'm a slow learner. Actually, this year my efforts have done pretty well. You might be interested to know that this was due to a focus on high dividend stocks. I also had a nicely profitable short-term Netflix trade, but that's an outlier. As is typical after a crash, since 2008, growth stocks have been shunned and value dividend stocks have been the stars. I've been riding that wave. I've been doing it in my taxable account. I wanted the tax loss if it had gone against me. But the wheel, as it always does, continues to turn. Value will fade and growth will rise again. Over time, as the research shows, the difference in return between them is negligible. If you've read this far, you know I think there are better choices, but if the dividend approach is comfortable for you and you go in with your eyes open and willing to accept the downsides, it can get you where you want to be. But do yourself a favor, track and measure your performance against an index fund like VTSAX. If you are going to all the effort picking individual stocks, dividend or otherwise, it only makes sense to see if it's paying off for you. Far more important, spend less than you earn, invest the surplus, and avoid debt. Cheers. All right, so I love both of these blog posts. I think they do a good job of highlighting the pros and the cons to dividend investing. The main reason that J.L. Collins is arguing more for index funds over dividend investing is that point that you are trading some growth for income, which in my case, I'm okay with that. And this is why my primary strategy is going to be index investing. And then I do want some dividends on the side just to help smooth the ride in an economic downturn, just to help me not panic. Again, I don't think I would ever be that person who would panic sell everything and get out of the market, but you just never know until you actually hit a major recession or a major market downturn. And I have not had that happen to me yet as an individual investor. So I do like the dividends for that steady stream of income. Even if stock prices go down, those companies are still going to pay their dividends. And J.L. Collins does make a good point that dividends are not a guarantee. Now, some of these people out here would lead you to believe that they are, but any company can decide to cut their dividend. Know that. Now, he did also say that they are loath to do so, and that is true, because if you are a dividend investor and you're investing in a company for dividends, and that company you're investing in decides to cut their dividend, what are you likely to do, right? So yeah, companies that do pay a dividend try not to cut those dividends ever, but it can and does happen. To help me a little bit with my dividend strategy, this is the reason why for my dividend portfolio that I do have, I have picked companies that for the vast majority of them are either dividend aristocrats or dividend kings, which means that these companies have been paying and increasing those dividend payouts year over year for at least 25 years for the aristocrats and at least 50 years for dividend kings. But again, if you choose those companies that are aristocrats or kings, these tend to be larger companies that may not grow as fast. So J.L. Collins is saying if you take that money you invest in those dividend companies and just put it in an index fund, you'd probably get better growth from the index fund. So which is better for you? That's up to you as an individual investor. We all have to figure out our own investing styles, and those styles may change as our time horizon for investing changes, as our age changes, and as our needs as investors changes. Right now, I am in the wealth building stage, and when I become financially independent and retire early, then I'm going to be in the wealth preservation stage. So I will be looking to reduce my risk and try to keep my portfolio as large as it can be and still support my lifestyle. This is why I find investing so interesting. I had no idea until I started going down this rabbit hole of investing all of the different styles that are out there. To me, I find this incredibly interesting. This is how you build wealth long term, guys, and you can make it as complicated or as simple as you want. Again, this was another long video. This is why I did not want to shoot these videos together. I knew it would end up being way too long. So if you've made it to the end of this video, I do appreciate you watching all the way through. Let me know what you thought of JL Collins's rebuttal to dividend investing down in the comment section below. I know some of you watching my channel are big into dividend investing, and I would love to hear your take on this. And while you're scrolling down there, don't forget to drop a like as well and subscribe if you have not already. I'll see y'all in my next video. Bye.